All right, so today I have the opportunity to talk to you about the basics of operating a 401k plan. So once you establish a 401k plan, you have certain responsibilities and you need to know a few things in order to operate it properly. Typically, you hire a team to help you. So your team could look something like this. So you see down there, we are the third-party administrator, that's Definity. We help you with plan design, your plan documents, compliance, and plan accounting. Your investment advisor, that's who you go to for investment strategies, advice, and employee education. Your record keeper, that's who holds your investments. That's where you send your contributions, you process your plan benefits. And as you see there, you're in the middle, the plan sponsor. You're responsible for things such as census data, contribution submission, and you're also the fiduciary. So oftentimes we get questions and from plan sponsors, who do I call for what? Things like how to deposit contributions, you'd want to contact your record keeper. If you're submitting contributions directly to them, they likely have a specific process for you to do that. What should you invest in? You're going to want to contact your investment advisor for that information and advice. And anything regarding plan operations, that's us. You call us. You call your retirement plan consultant. We can help you with things such as when somebody is eligible, what type of distributions are available in the plan, and what somebody's vesting is. We have some available materials on our website. I'd encourage you to take a look. This is a chart of who does what. So as you can see, plan sponsor, TPA, which is us, your record keeper, and your advisor. It goes down a list from initial plan setup all the way through your plan administration. And if you have any questions, feel free to reach out to your plan consultant. So a plan starts with a document. It's required to have a plan document that complies with all the requirements in the IRS code. You must administer your plan consistent with the provisions in your document, and also review it annually to make sure it's operating according to its terms. If you've had any changes within the year, that's something that you're going to need to bring to the attention of your retirement plan consultant so they can help you with that. And I wanted to mention that you need to make sure and sign and date all of your documents timely. The IRS assumes if you don't have copies of these documents or if they're unsigned and they were never done. And as some of you may know, you have received some correspondence recently about plan document restatements. We're currently in the cycle 3 plan document restatement. Now is a wonderful time to review your document. So let's get into plan operations. So your plan document, as I mentioned, governs how you operate your plan. It describes things such as when your employees become eligible, the types and amount of contributions and how they're divided among participants. It also describes when participants are vested and how benefits are paid. So when it comes to eligibility and enrollment, these are some things that you as a plan sponsor are required to understand. When we're gathering the census data at the end of the year, it's already been basically a full year. So if we determine somebody's eligible and you didn't quite know that or understand how that worked, it could cause some issues. As I mentioned there in bullet point number 2, if you fail to notify or allow eligible participants to enroll, you could face some additional funding towards that employee's retirement account. So it's really important for you to understand your specific plans, eligibility, entry dates, and all of that. And we are here to help. Call us any time of the year and we will help you through that. I'm going to go through a couple examples of how to determine somebody's eligibility and entry date. And we're going to start by describing or talking about the standard eligibility requirements. So this is the most strict you can be in a 401k plan. So minimum age 21, 1 year of service, 1,000 hours, and semi-annual entry dates, January 1 and July 1 for a calendar year plan. Now, as I mentioned, these can be more generous or flexible, such as age 18, 6 months, 500 hours, quarterly entry. So using those eligibility requirements in this example, we're going to talk about Mary. She's satisfying all of her eligibility requirements and entering the plan at the time where we would expect. So she's 35. She was hired on March 15th. Her first anniversary year is the first computation period we would look at, and we look at how many hours she received in that year. So in this example, Mary had 1,560 hours. So clearly she met the hours requirement. So then she would enter the plan on the very next entry date, which in this case is July 1. Now let's take a look at another example where we change a fact that Mary does not satisfy the hours requirement. And this is important to know because it shifts her entry date. So same hire date, her first anniversary year, March 15th, 2021. So in that 1 year, first anniversary year, she has 950 hours. So she does not meet all of the requirements. So we have to stop. Now we have to shift to the plan year. So in this first period, it was the anniversary year. She didn't meet the requirements, so now we shift to the plan year. So we're starting with 1/1/2021, and we go through that whole entire 2021 year. She does receive over 1,000 hours, so then she is entering the plan on January 1, 2022. You see how just by that one fact, it shifts her plan entry date by 6 months. Now with rehired employees, that one can be a little bit trickier because we have to determine, well, number one, you have to keep complete records of all of their employment dates if they're rehired frequently or even just one time. So if they've met eligibility in the past and they had been in the plan once before, then when they're rehired, they're in the plan on their hire date. So if they've met eligibility, but maybe they terminated prior to their entry date and now later rehired, they're in the plan because they've satisfied the eligibility. They passed their original entry date. They just weren't there. When they're rehired, they're in. It gets a little bit more complicated when they did not meet the eligibility requirements initially in their first anniversary year. And that's where you're going to want to contact your retirement plan consultant to help you walk through those. So here's a couple examples. Mary, we're using the same fact pattern as before. She, has 1,560 hours in her first anniversary year. She would have been eligible on July 1, as in the same as in our previous example, but she terminates 2 weeks prior to that. So obviously she's not there on July 1. Well, let's say she's later rehired on September 15th. That's her new entry date because that's the date that she, came back to work. So, and her entry date has passed. In rehire example number 2, she doesn't satisfy the hours requirement. So when she comes back, we have to shift and look at her hours on a plan year basis to determine if she's been eligible, if she's reaches the eligibility. And again, like I mentioned, contact your retirement plan consultant if you come across that, and we'll help you through. So once you determine who is eligible, there are some notices and documents that you need to provide to your employees. The first is a summary plan description. And then you have to provide an annual notice. So you might have done this already. Upcoming here for December plans, year ends, they have a safe harbor notice that's distributed by December 1st for the next year. You may know of some employees that might be eligible and you may have already given it to them, but if not, go ahead and give it to them when they're eligible. Beneficiary designation form. Every participant, anybody that has money in your plan, has to have a beneficiary designation form on file. And a deferral election form that describes for the payroll how much they want to withhold from their paycheck for deferrals, what type, pre-tax or Roth, and if it's a percentage or a dollar amount. An investment selection form, often provided by record keepers, it describes and it allows the employees or the participants to select from a range of investments available to them. And then if you have, say, a brokerage accounts, sometimes they require a separate application for that. So getting into plan contributions, there's 2 types of employee contributions. The first is pre-tax deferrals. So those are taxable. They're taxable upon distribution because you're not paying taxes now. Roth, you do pay taxes now on those deferrals, the salary, and the Roth deferral is deducted after those taxes are paid. So when it's deposited into your account, we separate, or the record keeper separates the principal, the basis that you put in, and then the earnings. And then once you reach 59.5, you've had 5 years since your first Roth contribution. At that point, your Roth distribution becomes a qualified distribution and no taxes are payable on those distribution benefits. So employer contributions. There are several employer contributions available in a 401k plan. Discretionary profit sharing. This is a contribution that must be allocated in a non-discriminatory method defined in your plan document. Discretionary match. Now, the discretionary contributions can be decided after the plan year has ended. And they can also have vesting schedules attached to them for those specific contributions. Some of them also have certain requirements in order to receive that, such as maybe a last day or hours requirement. And then you have 2 safe harbors. The safe harbor non-elective is a 3% of eligible compensation, and employee deferral participation is not required. With the safe harbor match, the employee deferral is required because it's matching what they put in. So we have the enhanced match, which is a 1 tier, and then we have a basic match, which is a 2 tier. In all the safe harbor contributions, they must be 100% vested, and you cannot impose a last day or hours requirement. So let's talk about forfeitures. So forfeitures is what happens when a participant terminates employment. They're only partially vested and they have to leave behind unvested funds. You can use these forfeitures in 1 or more of 4 ways, depending on the design of your plan. So you can allocate them as an additional contribution to eligible participants. We assist with doing that when we run the contribution allocations for the year. They can be used to reduce your employer contribution. So say you wanted to be depositing $50,000 in your employer contributions, but you have $5,000 in forfeitures to use, you can use it to reduce. Just know in that situation, number 1 and number 2, and number 3, you're not able to take those forfeitures as you're not able to use those as a deduction because they had already been used as a deduction in their past. So funding the safe harbor, I should mention, is a new feature. Before it was just reducing discretionary matching and profit sharing. Lastly, probably the most commonly used is to pay certain plan administration expenses. So deferral and contribution limits. So when we are running these allocations, we have to make sure that all of your contributions do not exceed certain limits for the year. So we have the employee deferrals plus the employer contributions, which is matching and profit sharing or safe harbors, plus forfeiture allocations. Now that equals your annual additions limit. And as you can see here, the limits for 2020 and 2021, those are the maximums that we can allocate to an individual. So we do have to take into consideration how much their deferrals are, what their employer contributions are, and if we're going to be using any forfeiture allocations in those contributions to not exceed those amounts listed there. And I should mention the age 50 and older, the reason why it's a little higher is because you're eligible for a catch-up contribution with your deferrals. So regarding compensation limits, we have to take into consideration also compensation limits, and this is just the maximum amount that we can use for contribution calculations. So let's say you make $300,000 and you're deferring, a certain amount per paycheck, and you're matching per paycheck. Well, we're not matching on $300,000. We have to cap it at $285,000. So those are some things to take into consideration when you have a match, or when you're planning. We can only take into consideration those indexed compensation limits for the year. Now, going through the compensation used for owners, as you can see here, it's a little bit different depending on your entity type. We use W-2 wages for S and C corps, sole proprietors, net Schedule C, and partnerships, we use your K-1 self-employment earnings. So highly compensated and key employees. This is an important concept to understand because this is affecting our testing, or it's how we determine that the testing is passing, or making sure that the benefits are allocated properly. So you're a highly compensated employee if you are more than a 5% owner anytime during the current or preceding year. And this also would apply if you have, say, your spouse or your parent or your grandparents or your children working for you. They are also deemed to be the same category as you, so a highly compensated employee, if they're an employee there. So, or if you have compensation over a certain indexed amount in the previous year. So if you earned $125,000 in 2019, you're going to be a highly compensated employee for 2020. And then $130,000 for 2020, you'll be a highly in 2021. And a key employee is generally the officers or the owners of the plan sponsor, the employer. Specifically, anybody who owns more than 5%, if they earn more than 1%, but have comp exceeding 150,000, and then a certain index dollar amount. So again, family attribution rules apply. Now, highly compensated and key employees. Why is it so important to determine who the highly compensated and key employees are? So we have to conduct non-discrimination and coverage testing to show that the plan does not favor the highlies and the keys over the non-highlies or the non-keys. In non-discrimination testing, we have a few different ones that we have to do every single year. Coverage testing is when the plan can demonstrate that the coverage rate for the non-highlies is at least equal to 70% of the coverage rate for the highlies. For example, if you have two highlies, both of them are benefiting from the plan, your coverage rate for the highly group is 100%. That would mean in your non-highly group, if you have 10 people, you have to cover at least 7 in order for the coverage testing to pass. In your top heavy test, this is where the key employees definition is determined. We need to make sure that if the key employee's total ownership of the plan assets is 60% or more, then the plan is considered top heavy. Typically, this means that the employer must make a 3% contribution to all non-highlies, and we work that into our contribution allocations. So with non-discrimination testing, this is for a traditional 401k plan without a safe harbor. Your actual deferral percentage test, the ADP test, compares the employee deferral percentage average for the highlies to the non-highlies. The actual contribution percentage test is the discretionary matching, so same concept. Here's an example. The highly compensated number 1 and number 2, as you could see, we take their salary deferrals, divide that by their eligible compensation, and that provides us with their deferral percentage. We then average those two percentages, and as you can see, we come up with 5.42%. We do the same thing with the non-highlies, and then for both the salary deferrals and if you have a discretionary match. As you can see, non-highly number 5 has 0, and also that 0 is factored into their deferral percentage. That only means that number 5, non-highly number 5, was eligible to participate in the plan, but they chose not to. We still have to factor them into the testing. So because of the annual testing, highlies may find that they can't contribute as much to their 401k plan as they would like, and this is dependent on the non-highlies participation. And in general, the highlies cannot contribute, or they cannot have a deferral percentage more than 2% greater than the average of the non-highlies. And as you can see here down in this scenario, this test does pass. The limit for the highlies would be 7.96, which is 2% more than the non-highlies average deferral percentage of 5.96. And as you can see, they're below that, so that this test does pass. So safe harbor 401k plans, they allow sponsors to bypass the ADP and ACP and other non-discrimination testing, and in exchange for providing eligible matching or non-elective contributions that are 100% vested. This plan type allows owners to maximize their deferrals regardless of the salary deferrals made by all the the other eligible employees. So submitting contributions, this is something that's really important and I get asked a lot about. Employee 401k and Roth deferrals. So those plans with fewer than 100 participants, you're required to deposit those by the 7th business day following your paycheck date. Plans with 100 or more participants, as soon as administratively feasible, but no later than this 15th day of the month following the paycheck. So if you are consistent with depositing your contributions within 3 days over time, that's what the deal wall is going to hold you to. With employer contributions, those are due by the due date of the company's tax return plus extension. So if you're, contributing contributions for 2020, those are due when you file your 2020 tax return next year. And pension contributions are due no later than September 15th for calendar year plans. So funding options for your employer contributions, as you can see below, the different types of contributions: safe harbors, matching non-elective, discretionary matching, and profit sharing. So option 1 is if you fund after the end of the year. This is, you're calculating it we're calculating it one time. We don't have any issues with having to take back pre-funded contributions to partially vested participants, anything like that. We gather the data, we calculate it once, we provide you the amount, and that's when you deposit it. Option number 2 is fund as you go. Oftentimes we see this with the safe harbors or sometimes with a discretionary match. Now, this is when you calculate on a per pay period basis, so you're relying on either your payroll program or you're doing it manually. And with this, sometimes there's chance for error. Sometimes it's not, the payroll isn't quite pulling in all of the eligible compensation. And then also if you're funding a discretionary match as you go, oftentimes we run into issues with participants terminating mid-year. And then we have to go back and calculate how much of the match they were not eligible for, such as if they had a last day or hours requirement in order to receive it, and then return that money and then pay them out. So it gets to be a little bit of a lengthy process when you match your discretionary match as you go, when you don't have when we have allocation conditions on it. So after the year has ended, we require certain information to get us started to gathering all the data to do your annual valuation. As you can see here, there's quite a bit of census data that we do ask for, and we are asking for this for every single one of your employees, regardless of their eligibility and their status. So we ask for additional items such as your payroll detail summary, W-2s, W-3. Obviously, we need your K-1s if you're falling into one of those categories with your entity. We need to know the owners, the ownership percentage, your officers, and their titles, any employees related to the owners and officers, any interrelated companies, and any changes in key personnel. Everything we do for compliance revolves around the data that we receive from you. So we need to make sure it's accurate and complete. And if you're not sure what we need, call us. Okay, so let's talk about vesting. So vesting is a participant's ownership in their account balance. The vested account balance is a portion that is non-forfeitable, which means that when the participant terminates employment and they request a distribution, they get their vested account balance. They do not receive their unvested money. Now, the vesting applies to discretionary contributions such as profit sharing and match. It does not apply to safe harbors, QNEX, employee deferrals, or rollovers. Vesting is also determined by the plan year hours. And most often it's about 1,000 hours that are required for 1 year of vesting service. I provided an example for 2 different types of vesting schedules. The first is a cliff, as you could see, for 1 year of service, and 2, vesting is at 0. Once they hit 3 years of service, then they're 100% vested. In the 6-year graded, they begin with the second year, 20%, increase 20% until they've reached 6 years of service, in which they will be 100% vested. Now, your vesting schedule could differ from this. and likely it's already been written into your plan document. If you have any questions, please feel free to reach out to your retirement plan consultant. So vesting schedules are ignored, and 100% vesting occurs if one of the following things happens. Participant reaches normal retirement age, which is described in your plan document. If the plan is terminated, everybody with an account balance is 100% vested upon plan termination. If a partial termination occurs, and that is when 20% of plan participants are terminated by the company, and this affects only the terminated employees, and we have to 100% vest them. And then also, if the plan allows, when a participant dies or becomes permanently disabled, we can 100% vest them. It's an option in the plan. So regarding plan distributions, you have to have a qualified event to take a distribution from the plan. The standard qualifying events are termination of employment, death, or disability. Now, you can add different distribution options into your plan via a plan amendment or write it into your document. So it must be allowed in the document in order to take one of these kinds of distributions. So hardships, in-service distributions after age 59 and a half, and in-service distributions prior to age 59 and a half. Now, that one has restricted sources. You can typically only take discretionary employer contributions. Required minimum distributions are for basically owners that are over age 62, 5% owners. The deadline for those required minimum distributions, which we assist in helping you calculate, is December 31st. Now, it's the year following you, the date following when you turn age 72, except for your very first RMD, you can actually wait until April 1st of the next year. Now, just know that if you do that, then you're actually taking 2 distributions that year, because that very next one, that second one, and everyone beyond that are due by December 31st. So plan loans. So if you want to have plan loans in your document, you must write that into your document via a loan policy. Typically, they are limited to lesser $50,000 or 50% of the participant's vested account balance. The maximum repayment period is 5 years. And if you're using it for a principal residence, it's 15 years. Also, payments must be made at least quarterly, typically through payroll deduction, using level amortization and reasonable interest rate. And what that might look like is prime rate plus 1%. So notices required to be distributed by plan sponsors. Now, these are a few notices that you might want to familiarize yourself with throughout the year. The enrollment package, we talked about that already. All the materials that somebody would need to enroll. Your safe harbor notice, that's included with that. It's due 30 days prior to the beginning of the plan year. So for calendar year plans, as I mentioned, it's due December 1st. The summary annual report. Now, this is what we provide after we're done with the annual report for the year, along with the 5500. It's due to be distributed to participants 60 days after the Form 5500 filing deadline. Annual fee disclosures, you'll often get these from your record keepers. They're due annually on a certain schedule, usually around this time of year. Auto enrollment notices, if you have auto enrollment in your plan, they're at least 30 days, but no more than 90 days before auto enrollment. And then any summary of material modifications for plan amendments, those are due 210 days after the close of plan year of the amendment. And then if you decide to change such record keepers or from brokerage account to brokerage account, you're going to need to provide your employees with a blackout, or your participants with a blackout notice. And that is due at least 30 days, but no more than 60 days in advance of any blackout. That's just to describe what's going to be happening with the investments, that they're going to be on hold until the funds are moved. We also have an annual calendar for plan sponsors. This is something that you can take a look at on our website in the additional materials. It just goes through an annual calendar and different dates and tasks that must be completed throughout the year. So it's pretty comprehensive. Some of it might apply to you, some of it might not. Okay, so let's talk about document retention requirements. I get asked these questions a lot. For the most part, you're keeping pretty much everything indefinitely. You know, all your plan document originals, amendments, beneficiary forms, payroll records, as I mentioned earlier, participant demographic information, loan and distribution records. The items that you can keep for 6 years following the plan year are your annual reports, 5500s, fidelity bond, and corporate income tax returns. So even with the best intentions, mistakes in plan operations can still happen. The DOL and the IRS, they have correction programs to help 401k sponsors to correct plan errors. They protect participants and keep the plan's tax benefits. You can self-correct many insignificant operational errors without contacting the IRS or paying a fee. And there's no application or reporting requirements. An operational error occurs when you don't follow the written terms of the plan. And even when the operational error is significant, we may still be able to self-correct if action is taken in a timely manner. So catching and fixing errors early is key, and call us as soon as you have any issues so we can help you. And that concludes my presentation, and I will open it up for questions.
Oh, yeah. Thank you so much, Candace. I know there were lots of questions in this particular presentation. So obviously a very important topic and a good place to get started. There were a couple of questions about materials. Where will we make materials available? On the page where you registered, there will be an addition sometime tomorrow that will show any of the materials that Candace had mentioned, including anything that might come up in a next presentation. If slides are available, we'll also post those as well as a replay for this particular webinar. So watch your email. You will get an email about the materials and the link to go to get those things. So yeah, thank you so much for those questions. Candace, we did get a couple of questions about your presentation. Are you game?
Sure.
All right, awesome. So Megan asked, is it the plan sponsor's responsibility to ensure that the plan is non-discriminatory, or is that something that the TPA should be watching for?
Both. So it's kind of a team effort. We do all of the compliance testing, and we will communicate with you what those results are. Now, it's important that the plan sponsor understands what goes into that so that they know what information to provide to us that will help us with those testing. But we do run the tests for the plan sponsor.
Wonderful. Now, there were a couple other questions too, like what if an employee was rehired, right? So they've been rehired, but they've never met the eligibility requirements. When do they need to meet those eligibility requirements?
So we take a look at, well, that's kind of a tough question. We need to take a look at their hire date. So they have to satisfy the standard eligibility. So they have to have 1 year of service. Now, again, this is with the standard provisions, 1 year of service with 1,000 hours. So once they satisfy that piece, then they can follow and come in on the next entry date. So at that point, if they have not satisfied at any point in the past, they're rehired, we then have to take a look at what point do they satisfy that 1 year, 1,000 hours requirement. So we look at plan year. Since they did not meet it in their anniversary year, we shift to the plan year.
Good. I'm so glad you're here to answer these questions. Thank you for doing that. One more question, and that is, what is a coverage rate as related to a highly compensated employee?
What is a coverage rate? Okay, so the highly compensated employees are what we use, I guess the definitions of a highly compensated employee is what we use to determine coverage. So, you know, back there a couple slides ago, when I was describing what makes a highly compensated employee, we essentially take that group of people against the non-highly group of people, and the coverage rate has to, you know, for the non-highlies have to exceed 70% of whatever the coverage rate of the highlies is. So it's important for us to differentiate who are the highlies, who are the non-highlies, and the coverage is who is benefiting. So if they're eligible, but maybe they're not going to be benefiting because of a last day or hours requirement, that is kind of a knock against that non-highly group. So if you have 10 people and 7 of them terminated prior to the last day, you have a 7 out of 10, so 70% coverage rate. And we have to relate that to the non-highly group.
Great, great. I think I would just reiterate, some of you have some very specific questions related to your plan. Best case scenario is reach out to your retirement plan consultant and let them know about your question so that they can help you. It may be specific to your plan, and there may be something about your plan that they need to know about. I did get a quick question, and I'm glad this one came up. So many of you are familiar with the other operating companies. It's a little off topic there, Candace, but it is relevant to this whole Definity presentation. Definity is now the new name of any of the operating companies that you may have already been associated with. So for instance, if you originally signed up with a PPA, as your third-party administrator, or the pension studio, or even America's 401k here in Dallas, that administrator has now changed its name to Definity, and now we're all working together. This is already part of what we're doing anyway, so it's just a way for us to come together and make sure that you know us as a new name. So if you've done work with PPA or the pension studio or Billings and Company, we are now Definity. The people that you've worked with in the past are still here, so reach out to your your retirement plan consultant, and they can help you with any additional questions. I love that question. As Director of Marketing, I love that question. That's great.